We're going to talk today about creating financial efficiency. What if there was a way to make your money grow faster and with greater safety? What if chasing market returns was not really a very good idea? What if hoping the market continues to go up isn't the best plan for your financial future? What if there was a better way, in fact, a much better way to plan for the future? What if implementing a system for creating financial efficiency was actually the better way of saving and investing for your financial future? Up until the mid-1980s, the typical retirement plan was a combination of Social Security and a guaranteed pension plan. All that changed with the creation of the 401k. Now, this was a seismic financial shift in how we plan for the future. With a guaranteed pension plan, the company put the money into your account, they managed it, or paid someone to manage it, and then the company guaranteed a lifetime payout. All you as the employee had to do was show up for work and meet your years of service to qualify for the benefit. But with the advent of the 401k, all that changed. If you didn't put the money into the account, that was not the company's problem. If market losses or downturns happened and reduced your account value, it was also not their problem. If economic events prevented them from contributing the match they had promised, which is something that happened during the 2008 through 2010 recession, you had to deal with less money going into your plan. And once again, it was not their problem. There was another issue created by the 401k becoming the primary source of your retirement income. And that issue was rate of return, meaning at what interest rate was your money going to grow? So for the past 40 years, we've been educated and consumerized, or marketed to, into focusing on and chasing returns. The problem is that contrary to popular belief, you cannot predict future returns. In fact, every mutual fund in your 401k has a disclaimer that past results have no bearing on future returns. But we've been led to believe just the opposite. We have been led to believe the market almost always goes up, and if it goes down for any reason, it always comes back. Here's the reality. The market does go up, and it does go down. The challenge is the timing. In the last 22 years, we have had two major market corrections that either cause people to postpone retirement or force them to come out of retirement because their retirement accounts lost too much money. So are we living into the last 40 years, or are we living into a future that is far different than anything we've experienced in the past? Are we living into a new financial paradigm that requires an entirely new way of thinking? We believe it's time for a new way of thinking. So let's talk about the power of creating financial efficiency as opposed to chasing market returns. So what does it mean to create financial efficiency, you might ask? Financial efficiency is simply this. It is the systematic process of identifying the highest and best use of every dollar you have. It is coordinating and integrating all financial decisions in such a way that not only do you protect those dollars from risk of loss, as well as taxation, but you reduce the wealth transfers that you have previously exposed yourself to. It is identifying ways that $1 can do the work of $3, $5, even $10, creating a multiplier effect, so that each dollar creates the maximum multiple benefits possible for you. Through the process of creating financial efficiency, you build wealth faster with less risk and loss due to the market volatility and taxes. This process, when understood and properly implemented, can also begin to offset the negative impact of inflation. Let's walk through an example of what we mean by having $1 do the work of many dollars, which is part of how you begin to create financial efficiency. Typically, you give your money assignments or jobs to do. You label those jobs: emergency fund, retirement fund, health savings account. You assign some of your money to pay for auto insurance, health insurance, life insurance. Some of your money is assigned to pay for your cars, trucks, boats, or other consumer purchases. Of course, you also assign your money to pay for your housing and other lifestyle expenses. In this scenario, you create a financial environment where your money is exposed to unnecessary taxation, lower interest rates, and in many cases, you are unknowingly and unnecessarily transferring money away from you. To create greater financial efficiency, you need to understand how to position your money so it creates as many benefits for you as possible, while at the same time earning higher returns, is protected from loss, and legally avoids taxation. What if you examined ways that some of the assignments you've given your money could be combined? Consider this example. You need and want some life insurance. You also want an emergency fund. And you want your emergency fund money to earn more than 0.25% interest. And you don't want taxes to reduce whatever return you do get. What if by combining your life insurance dollars and the money you've been setting aside to create an emergency fund, dollars that were previously doing one job each, and maybe not very well, in such a way that they gave you the same or greater benefits along with a higher return and was growing in a tax-free environment without risk? What if all the payments you are currently making on vehicles, thus transferring money away from you, could be redirected in such a way as to begin to accrue in an account that you own and control, meaning you get to use those dollars for your benefit instead of the financial institution's benefit? What if those dollars could be protected from taxes now and in the future? What if they could grow without risk of loss during market downturns? Everything being outlined here is part of a financial planning process that looks at how every one of your dollars is positioned. Is it exposed to taxation or risk? Is it being transferred away from you unknowingly and unnecessarily? It is a financial planning process that identifies your cash flow leaks and redirects them into accounts that you own and control, that accrue for your benefit and use. If you would like us to help you identify your financial leaks, if you would like to increase the financial efficiency of your money, if you would like to learn more about how to get your money to do multiple jobs, creating multiple benefits for you and your family, then click on the link below to schedule a no-cost 30-minute financial efficiency consultation with one of our highly trained associates. We also encourage you to click on the other link to gain access to our free financial educational video series. Let us show you how to build more wealth faster with less risk and pay far less in taxes. Click on the link below to schedule your free financial efficiency consultation. This is Scott Christensen again, and we hope that you found this information to be valuable. Please take a second to click on the subscribe button, as it helps us to get our educational content out to more people. And if you want to get notified when new videos are posted, then also click the little bell. For more educational content, such as our books and our free members website, strategicwealthbuilder.com, click on the links in the description area below. And thanks for watching.